You know the name, George Soros, legendary trader, market wizard, and the guy with one huge idea, reflexivity. It's the thing they teach in finance classes, right? His secret weapon, the key to his billions. But today, we're going to pull back the curtain and ask a simple question. Is this famous theory even a theory at all?
So, what's the deal here? Is reflexivity this groundbreaking, earth-shattering key to understanding the markets? Or is it something else entirely? That's what we're digging into. We're going to see if finance's most famous big idea is really all it's cracked up to be.
All right, so let's start with the legend, and you've probably heard it. The story goes that George Soros wasn't just some lucky trader. No. He had this secret weapon, this deep philosophical insight called reflexivity. And that was the key, the thing that supposedly unlocked his massive fortune. I mean, it's the stuff of Wall Street legend for sure.
But what if that legend is just that, a story? Here's the core idea we're going to unpack today. What if reflexivity isn't actually a predictive tool at all? What if its fame has almost nothing to do with how powerful it is as a theory, and everything to do with the billionaire who made it famous?
Okay, so before we can tear down the myth, we've got to understand what we're even talking about. So let's get into it. What did Soros actually mean when he said reflexivity? Let's break it down. So here's the core idea. Reflexivity basically says that markets aren't a simple one-way street, where a company's fundamentals dictate its stock price. Instead, it's a two-way feedback loop. Think about it. Rising prices can actually improve a company's fundamentals. Maybe they can raise money more cheaply or attract better talent. That in turn pushes the price even higher. And of course, the whole thing works in reverse on the way down. The key takeaway, prices don't just reflect reality, they actively shape it. Now that sounds pretty clever, right? It's a really neat way to think about those wild market manias and panics. But here's the big question, the one we really need to ask. Did Soros actually come up with this? Was he the first person to spot this dynamic? Well, the short answer is no. The truth is, the basic ingredients of reflexivity were already out there, long before Soros put his name on it. I mean, you had John Maynard Keynes talking about his beauty contest idea, where investors are just trying to guess what other investors think is attractive. And Hyman Minsky, the guy practically built his whole career on showing how feedback loops create financial instability. So Soros didn't invent the idea. What he did was give it a really, really good brand name. Okay. So we've established it wasn't exactly an original idea. But hey, maybe it was still a useful one, right? I mean, that's what matters. And people who believe in reflexivity, they always point to this one famous case as the ultimate proof. The big collapse of real estate investment trusts, REITs, back in the 1970s. So let's take a closer look at that. So the story goes like this. In 1970, Soros publishes this paper saying mortgage REITs are in a classic reflexive bubble. And then 3 years later, bam, they collapse. So, case closed, right? He nailed it? Well, not so fast. First of all, waiting 3 years for a prediction to come true, that's not exactly what you'd call precise timing. But more importantly, look at this. REITs collapsed again and again and again in the decades that followed. So if the theory is always true, if there's always a feedback loop, how does it help you predict when the crash is actually going to happen? And that right there, that is the central problem. It just perfectly illustrates the issue. A theory that you can use to explain why the market went up and why it went down, but only after it's already happened, that has exactly zero predictive value. It's kind of like predicting, hey, there's going to be weather tomorrow. Yeah, you're never wrong, but you're also never, ever useful. So what was really going on in that 1970 paper from Soros? Well, if you actually go back and read it, it's not some mystical application of grand universal theory. It's just really good, sharp, clear-eyed analysis. He was pointing out the obvious dangers of too much leverage, the risks in their financing models. Honestly, any good analyst could have spotted it. The only difference? When George Soros said it, his reputation made people sit up and listen. Which brings us to the real mystery, doesn't it? If the theory isn't original and it isn't predictive, why is it still talked about all the time? Why does this myth live on? Well, the answer, it turns out, has a lot less to do with finance and a whole lot more to do with human psychology. Okay, let's break down why it's so sticky. First, and this is the big one, the authority of the speaker. It came from George Soros. I mean, when a billionaire investor tells you his secret to success, you're going to listen, right? Second, the idea itself is incredibly flattering, especially to traders. It tells them that their trades, their buying and selling, aren't just passive bets on reality. No, they're actively creating reality. How cool is that? And finally, its biggest weakness is also its greatest strength. It's super vague. It's so loose that it can be used as a perfect all-purpose explanation for literally anything that happens in the market, boom or bust. All right, so we've looked at where it came from, we've questioned its predictive power, and we've explored why it's so famous. So, where does that leave us? What's the final verdict on reflexivity? Here's the bottom line. When you have a so-called theory that's so vague it can explain any possible outcome, well, it's not really a tool for analysis anymore. It's something else. You could call it a philosophy, I guess, or if you want to be a little more blunt about it, it's basically astrology for hedge funds. And really, that's the punchline. Look, the core idea that markets are these crazy feedback machines, that's totally valid. It's absolutely true. You see it happening all the time. But that idea is not unique to Soros, and it gives you absolutely zero edge in trying to time the market. What it is a fantastic brand. It is not a scientific breakthrough.
And when you see it that way, it kind of reframes the whole story. Soros's real, undeniable genius wasn't being a groundbreaking financial theorist. His genius was in mythmaking. He took a valid, but let's be honest, kind of obvious idea, dressed it up in all this complex philosophical language, and then sold it to the world as the secret sauce behind his incredible success. Now that is marketing on a legendary scale. So after all this, the next time you're at a party and someone brings up Soros's grand theory of reflexivity, what should you think? What is this thing really in the end?
Well, you can think of it in one of two ways. At its absolute best, it's just good old common sense, dressed up in a really fancy tuxedo. But at its worst, when people try to use it to claim some kind of predictive power that it just doesn't have, well then, it's like a broken clock wearing a three-piece suit. It looks super impressive, but it's only right by pure random accident.